Now let me just add a few comments specific to the most important risk discussed in this FSR. The difficulty that highly indebted households would have servicing their debt if they were to face a sharp decline in their incomes or a sharp rise in interest rates. This situation raises the risk that a shock to the economy could trigger a correction in house prices. The probability of this risk materializing is low, but if it did occur, the effect on the economy would be severe. This risk would be greater if house prices were judged to be overvalued relative to fundamentals. Now, bank economists have done some new research on this risk, highlighted in a box in this FSR and in a research paper released today on our website. Although there is considerable uncertainty around this question, various approaches, including our own, suggest that there is some risk that the housing market is overvalued, and our estimates fall in the 10 to 30% range.
What impact do you think your comments will have in the real estate market as we look ahead to the spring market?
Well, first, what we've done is we've published a paper today which adds to this, to our insight into this situation. It's not the definitive point to put a pin in a number, and so I would frankly resist this citing of the 30% or 20% or any of these. What it does, there are a number of different methodologies that economists can use to assess this. And they kind of range in that sort of 10 to 30% range. And so it's, in a way, reassuring that we take this model, which is not just about Canada, but actually analyzes over 40 housing cycles, housing correction cycles around the world. So it gets a lot more information into that question. Housing markets, of course, differ from place to place, but the fundamentals and how they drive are not that different. People behave similarly in other housing markets. So that gives us a lot richer kind of insight into this. So the good news is that that model, simple as it is, kind of gives you that same 10 to 30% kind of range of possible overvaluation. And so that kind of validates it, and because it cross-validates other things. But it also tells you some other things, like according to that, we've been overvalued by at least 10% and probably more, actually, for several years. So it's not as though we became overvalued yesterday by some number. It's actually been building up for a really long time. And as I said in my opening remarks, when you contrast that to 81, 82, and 91, thereabouts, there's a really big difference if you look at the charts in that paper. That in preceding those corrections in housing markets, we had a very sharp run-up in prices. And it was in the context of building inflation pressures overall. So often rising house prices are a symptom of exactly that. It's just part of the process. And so interest rates were rising, and of course we know what happened, that things slowed down, and there was a recession in both cases. So the housing correction then went into the recession period, so there were high unemployment was rising and so on. So you have all those ingredients, none of which are present today. And so the model can't do everything. It doesn't, for example, identify markets that have restricted landmass. So, for example, Hong Kong or Vancouver, where there's only so much space. So it can only do so much for us, but it does give us a little bit of insight. And the last thing I guess I'll mention is that because it's a very high-tech thing, it's a very sophisticated model, what we call a logit model. And what it tells you is it also calculates a probability that there's a housing correction. And that probability is actually really low compared to those other historical episodes. And actually it looks like it's falling. But I think the more important thing for us is that the model is about the past and now, and the question is what's happening next. Well, we believe the economy is gathering strength. It's beginning to rebuild itself. It's going to create new jobs, and income is going to go up, and all those kind of metrics are going to start to look better. And so the sustainability of the housing market will be buttressed by that. So that's our main source of reassurance from this.